Okay, and welcome back, students who are taking Math for Business and Finance and Math Applications, and we're doing the odd number problems for the drill problems. And in the last video, we stopped on number 7, so we're on number 9 now. And again, if you don't understand something, watch the video again. And if you still have questions, feel free to telephone and speak with an instructor. Okay. All right. So let's see here. Okay, for this problem, I rearranged the information on the slide. As compared to what was in the textbook. I mean, it says here given, and so there's 20,000 shares cumulative preferred stock, 225 dividend per share. There was 40,000 shares of common stock, and then in 2013 a dividend of 8,000 was paid. 2014 0 was paid. In 2015 160,000 was paid. And it asks how much will preferred and common stock holders receive each year. Okay, this is a little bit more complicated, and this is the issue that you have with dividends and preferred stock. And I'm going to I'm actually going to do this problem twice because it just as a building thought process so that you have a little bit better understanding. I mean, I covered this in the theory videos, but it may make sense to actually show you while I'm working a problem, so it helps you understand what you're doing and why you're doing it. All right. So let's first of all assume, before I actually do the actual problem itself, let's assume that we don't have 20,000 shares of cumulative preferred stock, and that we only have 40,000 shares of common stock. Okay. If a dividend is paid, right, in this case here for the year 2013, $8,000 was paid. So what we want to know is, how much is the dividend per share for each one of those 40,000 shares of stock. Now remember, you're doing this because you don't know, I mean, one person can have 100 shares, another person can have, 200 shares, another person can have 1,000 shares. You don't know, I mean, the company knows exactly who has shares and how many shares they have, but you can't just, you need to find one common amount that you can apply to all situations, and that's why we take our dividends and we divide by the shares, and I'm going to just make, that's our common stock shares, okay, in order to get our dividends per share. And then whatever that dividend per share is, we multiply it times however many shares of stock that you actually own, and that's how many, if you own 100 shares, you're going to multiply it by 100, and you're going to know that's how much you're going to get. If you owned 1,000 shares, well, you would know how much that other person would get. All right. So on the simplest level, when we only have common stock shares, okay, we take our dividend of 8,000 and we divide it by however many shares of stock there are. In this case, it's 40,000. Right? So 8,000 divided by 40,000 is $2 a share. Okay, so that's $2 per share. And then, depending if person A had, let's say person A had 100 shares, person B had 200, person C had 1,000. Okay, well, we would take the person A would receive 100 times the $2 or $200. Person B would receive 200 times the $2 or $400, and person C would receive $2,000. Okay, and so that's how it works on the most simplistic level. Now in 2014, nothing was paid, so shareholders don't get anything. And then in 2015, there's 160,000. Well, again, you're taking the 160,000 and dividing it by 40,000, and that comes out to 160 divided by 40 comes out to $4 a share. Okay, so in 2015, person A, assuming that we still have the same stocks, same amount of stock purchased, person A would receive 100 times the $4 or 400, and so on and so forth, right? It's 800 and that's 4,000. Okay, so that's kind of how the dividend per share amount gets applied to however many shares of stock that the person owns. And we're dealing with this in terms of common stock at this moment in time because it's the simplest way to see this. Okay, now I'm erasing all of this, and we understand how we're getting the dividends per share in this particular example because we're only looking at 40,000 shares of common stock. Now, this all changes when we end up, if we have preferred stock. And with preferred stock, you can have, preferred is exactly that. It's preferred. It has its own specifications, and there is no one set way of doing this. It's all depends upon what the company decides. Okay? They can start out with common stock and sell shares of common stock, but they may choose to have preferred stock for maybe their employees, okay, or maybe just for the executive management. They'll have an opportunity to buy those preferred shares, and there's only a limited number, so they might put the preferred shares out there, and either you want them or you don't. If you don't want them, then somebody else will get them, okay? And when they decide upon the preferred shares, what they do is, there's several different parameters, several different things that they can do with it, with those preferred shares of stock. It's not like common stock. Common stock is just one share. That's it. There's no other additional specifications to it. But with the preferred, what they can do is they can say, okay, we can determine how much of a dividend you're going to get per share. Okay. In this case here, for this problem, they're saying they're getting $2.25 of a dividend per share. They could have decided that that could have been $4 per share. It could have been $3.75. They get to decide whatever amount that is. And of course, they want to make that attractive for those preferred shareholders. So they choose a number, a dividend, that is, that's kind of like worth it for them. Now, so they sit there and say, okay, this is how much we're going to give you as a dividend per share. In this case, it was $2.25. Now, you have the next thing that they play around with is whether it's cumulative or it's non-cumulative. Okay. What does cumulative mean? Well, it means, basically adding again and again and again, meaning and we'll use these years just as an example without doing the math here. I'm just trying to impress upon the process here, or the thinking. Okay, we have 3 years, and they're saying that they're supposed to get, the preferred shareholders are supposed to get $2.25 per share. Okay, well, if that's the case and there's 20,000 shares, 225 times 20,000 is $45,000, right? So 225 times the 20,000 shares is $45,000. Okay. Now, being a preferred shareholder, right? What the company is saying, we want you to have $45,000 worth of dividends each and every year. Okay, that's based upon the price, right? Now, if we don't pay you, okay, then the next year we're going to owe you 45,000 more. Okay, so that means we're gonna owe you 90,000. It's cumulative. It keeps on adding up and adding up. So the next year after that is 45,000. So that's 135,000 the following year, and the amounts add up from year to year to year. But if that's if we don't pay it, meaning if in that first year, if we owe you 45,000. Well, if we're paying a dividend, if we decide to have a dividend of 45,000, okay, in that first year, then we've paid off and the amount that we've decided that you're going to have. So then in the next year, okay, we owe you 45,000 more. But if in that next year, if we only pay, say, 20,000, okay, that means we're going to owe you 25,000 more. Okay, so that's beginning to accumulate into the next year, into the following year. So the following year we add 45,000 more, and now we're up to what, 70,000 that has been accumulated that needs to be paid. And maybe that's the way to explain it. It's accumulated that needs to be paid to the preferred stockholders over and above, even before the common stockholders get a look at the dividend. Okay, so the company can declare the dividend, but they have to take care of the preferred stockholder before they take care of the common stockholder. Now, that's the idea behind cumulative. All right, so when we're looking at that preferred shareholder, we're looking at cumulative. But they also may say that, okay, we don't want to have it as cumulative. We want it as non-cumulative, meaning, we have the preferred shareholder is going to be entitled to the $45,000 each year. So in that, in 2013, they're entitled to 45,000, but if it doesn't get paid or a portion of it doesn't get paid, if this is non-cumulative, that means it won't continue to add up. It won't continue to build up. Okay, so if zero dividends are paid in 2013, when we come to 2014, the preferred shareholders are going to be entitled to 45,000, but because it's non-cumulative, they don't get, they're not entitled to what was owed to them back in 2013, even though nothing was paid out. So in essence, they become more like a common stockholder at that time, because the common stockholder, they only get paid on a dividend. They only get paid a dividend if there's a dividend that's paid, and only after the preferred shareholders get their cut out of it. Okay, so when it's non-cumulative, now the preferred shareholder is becoming more like a common stockholder, with the difference being that they're guaranteed a specific rate, whereas the common stockholder, they're only, what they get is divided amongst whatever's left over. Okay, so I hope that made sense. Okay, and then there's, when we're talking, there's also a term that you need to be aware of, and it's called in arrears. And this relates to cumulative and non-cumulative. Okay, so let me go back again, and I'm basically going to cover the same idea and same information that I just spoke about. Okay, but you'll see what it means by in terms of being in arrears. Right, so the preferred shareholders there's 20,000 shares at $2.25. A dividend per share means they get $45,000 of dividends. Okay, now, and I'm going to work through this problem so that you understand what the term in arrears means. Okay, so the preferred shareholders are entitled to $45,000 each and every year. Okay, this is cumulative, right? Meaning whatever isn't paid from the year before gets carried over into the next year. It's brought forward. Okay, so in 2013, right, the preferred shareholders, I'm going to make PS for preferred stock and CS for common stock. Okay, so the preferred shareholders, the preferred stock, is entitled to $45,000 for the year 2013. Okay, now $8,000 of dividends were paid. All right, so that $8,000 has to, whatever amount of dividends is declared, it has to satisfy the preferred shareholders first, and then anything that's left over goes towards the common stock, the common shareholders. So since only $8,000 was paid, that $8,000 goes to the preferred shareholders, and that means that they're short $37,000. They're still owed $37,000 for the year 2013. All right, that $37,000 is what's called in arrears. Okay, so the preferred shareholders are $37,000 in arrears dividend payment, meaning that's what's back owed to them. All right. Now, because there wasn't enough to cover the preferred shareholders, the common stockholders get zero. Okay, because only $8,000 was paid, it all goes to the preferred shareholders. The preferred shareholders are now in arrears, $37,000. Right, we move on to 2014. Okay, so the preferred shareholders get 45,000. They're owed 45,000 more because it's cumulative. Okay, they're paid. No dividend is paid. Okay, so that means for the year 2014, they're still being owed 45,000, and because there was no dividend, common shareholders get zero. Right? Now, what is in arrears for the preferred shareholder? Well, at the end of 2014, they're behind by 82,000. All right, so the preferred shareholders are in arrears for 82,000, meaning that's how much is owed to them from the previous years. Okay, now 2015 comes along, and the preferred shareholders get their 45,000. Okay, and now remember, they're still being owed this 82,000 right here. Okay, the dividend for this year is being paid 160,000. So out of this 160,000, the very first thing that has to happen is we have to take care of whatever is in arrears, the 82,000. Okay, so let me write this down. Let me erase this up here. I'm just making space. Okay, 160,000 is the dividend that's being paid. 82,000 is in arrears. Okay, so that 82,000 goes to the preferred shareholders for payments of years 13 and 14. All right, and that gives them a remaining amount of 78,000. Now, out of the 78,000, they're going to pay the preferred shareholders what is owed to them for the year 2015. So 45,000 is owed for 2015, and that means now there is $33,000 left over. Okay, so as far as the preferred shareholders are concerned, they're all taken care of. They're all brought up to date. Nothing more is owed to them because they were paid the 82,000 in arrears, and they're paid the 45,000 for the year 2015. Right? So out of the 160,000, we have 33,000 that is left over, and now that 33,000 can be paid to the common stock shareholder. Okay, and of course we can do the math for that to find out how much per share. All right, like I had done in the very beginning of this video. There's $33,000 of dividends to be paid, and it's divided by the 40,000 shares. So that means each share is going to get 0.8 and this 825. Okay, they're getting 82.5 cents per share. Right, so the common stockholder will get 82.5 cents per share for however many shares that they're owed. Okay, if somebody has 100, it's 100 times 82.5 cents. If they have 1,000, it's 1,000 times 82.5 cents, and that's how much they'll get. So all the remaining amount of that dividend then is paid out to the common stockholder, and then basically we're back to even. We're squared away. The preferred shareholders are happy because they got their dividends. The common stockholders are happy because they got a little bit more of a return on investment instead of just the appreciation of the price of the stock. Okay, and the company's happy because they have the money that was paid for the stock in and of itself at whatever price, so that they can use to improve buildings, get more equipment, expand operations, or do whatever. Okay, just be aware that stockholders buy stock, and that money's available, and that could go into the executives' pockets for their $100 million a year salaries and so on and so forth. The company decides what they do with the money. You as an investor, you buy the stock, you're looking for appreciation, in the stock price, and you're also looking for a dividend. But once you give the money to the once you buy the stock and that money goes to the company, they decide what to do with it, and in whatever fashion they feel. Okay, and it's up to you to trust them to do the right thing. All right. So this is problem 21-9, and it's taken me 20 minutes to explain this. You know, understand that this is, we went from a basic situation of common stock, and then we added in preferred stock. And to be honest with you, this can get a lot more complicated. All right. It all depends upon the terms of the preferred stock. This is by no means the end all be all. For example, and I'm not going to go through it, but just to give you an idea, they can say, okay, I want 25% of the dividend to go to the preferred shareholder, and then I want 50% to go to the common stockholder, and then I want the remaining 25% to go back to the preferred shareholder if there is any left over, and I can decide whether that's cumulative or non-cumulative. Okay, so there's a lot of different things that can happen when it comes to paying out dividends. All right. And that's just to make you aware. Those people who are going into, who are in the business curriculums, you'll see this again in your accounting courses, and definitely when you are in intermediate accounting, if you're an accountant or you're in the finance curriculum, you're going to see the much more in depth than what we have here. But for right now, this is the extent, and I hope you understood this. If not, go back and watch the whole video again. And if you still don't understand where the math is coming and going from, feel free to contact an instructor. I do believe that there's going to be other problems like this in the drill problems and the word problems and summary practice test on how to pay out dividends. So you might want to watch those, actually work through them and watch those to get a better understanding. All right. So I'll see you in the next video for problem 21-11.